Welcome back to Credit Conversations. I'm joined once again by Craig Lupton, and today we're joined by our automotive specialist consultant, Karl Williams. So Craig, last time we met, it was the end of springtime earlier this year. Consumer credit trends were looking in a fairly good place. We were seeing good growth across the board. Delinquencies were fairly stable and as expected at that point in the year. So how is that trend starting to change?
Consumer behaviour, we're really continuing to see that growth in unsecured lending that we saw basically throughout the entirety of the first half of 2025. Demand has continued throughout the summer months, particularly for cards and loans on there. And I've said this before in these sessions, it's across the risk spectrum. So we're getting products being offered to both consumers in the lower risk end of the market, but also the more higher risk or needy end of the market. There's product offerings out there for consumers. They are meeting that supply and demand on there, and we're seeing some really strong numbers in the card and loan space. But it's not just restricted to those two markets. Mortgages, we've seen some strong levels of approvals. The stamp duty change, we've seen base rate drops into the market this year. We've seen more competition from lenders. We've also got more supply sides of properties on the market, giving consumers choice when they're going out there looking for a mortgage on there. So again, that market is showing strong levels of approvals, which is then leading to stronger drawdowns as they come through on there. So retail finance is also continuing to grow. Slow, sluggish start to the year, but now we've started to move through the summer months, traditionally where we see more retail finance being taken out. And alongside that, buy now, pay later, again, continues to be a mainstay of the consumer's means of transaction and buying goods and services out there. And then finally, really, the auto finance market. So we saw a slow start to the year in auto, but we have started to see some strong numbers. March was a particularly good month in terms of new business. New business throughout the summer has also continued to bob along at quite a nice rate in terms of that. And obviously we've had some movements in terms of EV grants, which are helping to boost the auto finance market.
So Karl, how does that then correlate with what you're seeing as our automotive consultant?
I think it's really a dynamic market at the moment with lots of things happening in the markets. We've had all the DCA commissions element going on in the background and some uncertainty of the findings of that. We've had some perhaps inconsistency in the targets that have been set for the number of EV vehicles that the lenders have to finance, and that's effectively new vehicles they had to finance, and those targets very difficult to hit. And then I think, just even from a consumer demand perspective, what is the consumer demand for the vehicles that are coming off of leasing into the market as used vehicles, and how do you provide that kind of certainty to consumers so that it's the right choice to make to purchase those EV vehicles? So a load of dynamics for lenders to work within, but I think what we're seeing is kind of innovation in the market from traditional captive finance houses and banks in terms of what products they want to put out to market, but also new competition in market as well from other providers of new types of finance for those vehicles.
Mm-hmm. You mentioned about pricing of new versus used EV vehicles. Craig, are you seeing anything there?
Yeah, so in the data we see the trends moving. So the average value of a EV vehicle that's been financed privately is starting to come down on that, and that is due to the mix of vehicles that are being financed out there. So the growth in the more prevalence of used vehicles making it into that market space on there. We're starting to see more used EV vehicles being financed privately by consumers, which is driving down that overall value on there. But there's also cheaper vehicles coming out onto market as well. So consumers who are buying even new EVs, obviously there's more choice out there for them. There's more range for them to have a look at, and therefore we're seeing some values drop on there as well.
And you mentioned about the electric car grant as well that's now available from the government. Are we anticipating that will help support the lenders in offering more electric vehicles out to their consumers?
It's definitely a positive move in terms of the range of grants available. It probably does still target some niches of customers and doesn't necessarily apply to all customers, but I don't think it's totally broad across all consumers, so it means that lenders have to be aware of which groups they can target for that growth in the market, but it certainly will help.
I think we've seen already on the back of the EV grant announcement, demand spike in terms of auto. There's more people looking for auto finance deals out there, and that's continued through into August on there. So I think it bodes well for the market on there. So
EVs aside then, what are lenders starting to do now to shift and to be able to offer more affordable credit generally?
I think a lot of it comes in, particularly when you look at the price of EV vehicles, a lot of it comes down to things like what product offering you can give your consumers. So the cost of a HP might be prohibitive to lots of consumers. There may be some uncertainty and nervousness around PCP products, particularly around the future value of the vehicle. What's that vehicle going to be worth for a resale value? And I do think that then pushes consumers potentially from a view of ownership towards subscription. So we're seeing more subscription models in the market. So it may be that it's more expensive, it may be that they're shorter loan deals, but it certainly gives the customer a clear view of the financial commitment they're making. I think that's really important when people are making choices. What's the total cost of ownership over the period that I want to use that vehicle? How do I want to use that vehicle? And ultimately, do I want to own it at the end? It's a fairly new dynamic in the market, and it'll be interesting to see how that plays out.
So then, in terms of how the lenders are determining who they lend to, the processes in order to find the right people, offer them the right products, and make sure they're all onboarded and everything else, how is that process starting to change?
I think there's a general, and there has been for a number of years, a general kind of transition to a lot more of the interaction being direct with the consumer who's purchasing the vehicle. So whilst there's always going to be a place for dealerships there, much of it has and will continue to move to that direct consumer model, and that aligns to the different products we talked about being available in market. That's the best channel to service those products. In order to fulfill that, the lenders have to have those digital journeys enabled. And there's a whole facet of things around identity fraud, credit risk, affordability, vehicle valuations that kind of package into that deal and decision that's made for a consumer. So I think having kind of agile digital journeys and the flexibility to change those at speed, particularly as we've seen with dynamics in the market changing rapidly, is absolutely critical to lenders being successful going forwards.
So taking a look forward then, we've had some good news about interest rates. Mm-hmm. Just talk us through what's changing now.
So I think if you look at the underlying economics, there are some grey clouds, if you like, in the sky. We've got inflation still elevated on there, and that's brought about by some of the costs, particularly associated to national insurance rises. Now, the outlook is that those will fall back into the start of next year. So again, there is a positive around there. Also, the interest rates currently have come down again, and we're expecting maybe one more this year, which will be obviously it's a link to the inflation story. But I think that's again giving consumers a little bit of confidence, and that's reflected in the latest consumer confidence index. That's again showing a positive. Consumers are more positive about their personal finances, and therefore I think again it helps give a bit more of a less gloomy outlook, shall we say, in terms of the next 6 months.
So maybe some grey clouds there, but sun shining through.
Absolutely, yes, absolutely.
Thank you both for joining me today. It was great to have you once again, and we look forward to seeing you again on our next Credit Conversations.